We have with us Mr. V. Srivatsa, EVP and Fund Manager at UTI Mutual Fund, who's joining us now from Mumbai. Thank you so much, Mr. Srivatsa, for being with us at NDTV Profit. Now, we've started getting the exit poll results, and the poll of polls suggests that, in UP, the BJP could be ahead. In a number of other states as well, the BJP could be ahead. The markets for now seem to be digesting this kind of news. Do you think this has all but been factored in by the markets? Or do you think they will react one way or the other on Tuesday once we have the results?
See, one thing is that if you look at the markets in the last 2 months, I think it has given a very strong return in the last 2 months, led by various factors. I think one amongst them was a positive macro factors that we saw in the first couple of months. And more specifically, some of the index heavyweights have done very well in the last 15 days, whether it's Reliance or whether it's Bharti or whether it's HDFC Bank, because of certain company-specific factors which has also pulled up the index in the last 1 month. Now, to some extent, I think most of the positives are factored in. So if there is any big negative disappointment on the UP election in terms of the ruling party not getting to power, there could be a chances of an overreaction. But having said that, in the last couple of years, we have seen some state elections where results have gone very adverse versus expectations, and still the markets have kind of bounced back from those levels. So we don't see this as a very big kind of a binary outcome. But yes, the way markets are, they would be in search of one negative news to pull it down, and this could be one of that. And probably a positive reaction may not also pull up the market very much, because in our view it is probably on the fair value zone.
All right. Previously, we've seen the markets shrugging off bad news and moving on. But today, the global scenario also remains uncertain. Do you think if there is a little of a correction, it will offer a good opportunity for long-term investors to get in, or should they wait for the global picture to become clearer? How would you approach the markets now, given that they have run up a lot since December?
Yeah, so we are waiting for some amount of correction, but not a very big correction, probably 3-4%. But having said that, I think we typically tend to invest our money across market levels. So we don't take an active cash call on sit and cash and wait for the market levels to correct. So whatever sector looks attractive at that particular point of time when we get the money, we tend to invest in those sectors. And as you can see in the last 2-3 years, whenever the markets have shown some amount of correction, as for example, we saw last year, beginning of the year, Jan-Feb, the markets corrected significantly. That provided a very good opportunity for investors to put in their money and to invest in the markets. And the last 1 year, the equity markets have given a 20% plus returns. So whenever the market corrects, whatever is the quantum of correction, I think investors should have the confidence to put in more and more money as and when the markets correct.
Right. Can you just talk to us about the fund flows? And are you surprised, even looking at the Feb numbers? Feb and March are generally, spaces where mutual fund flows slow down because people invest into insurance, some of the other tax-saving bonds. That's why, it tends to be lower. But this time around, it's higher than Jan and December.
Yeah, actually what has happened is even mutual funds have their own tax saving schemes. Now my sense is, I don't have a hard data backing it, but probably that share of pie in the overall tax saving budget of an individual has probably gone up. Because if you look at the ELSS schemes, typically they have a much lower lock-in or a much higher liquidity than other tax saving instruments. And over a longer term, if you see 10 years, 15 years, ever since these have been in vogue, they have managed also to give a much higher return than the other traditional forms of tax saving schemes. whether it is an NSE or whether it is a bank fixed deposit. So you have benefits of both. So I won't be surprised if the share of ELSS has probably gone up substantially over the last 5 years and 10 years. So we are still, continuing to see very good flows across the tax saving schemes. So in UTI we have tax saving schemes where we have launched a smart plan. So we are continuing to see very good flows across the 3 schemes that we have on offer.
Right. As far as, I was not only talking about the schemes, and why the flows are high, but do you believe that overall flows are pretty high and that has surprised the industry also?
Yeah, it's kind of surprised the industry, but I think a large part of the flow is also related to the fact that most of them are sticky. Like we have an SIP book, a running SIP book of 3,000 crores plus. And as and when, the markets also correct, typically investors tend to shift money. So they've already parked a lot of money in, say, a liquid fund or other, traditional debt funds, so that whenever the markets correct, it typically gets, flowed to equity. So there is a good amount of money sitting in the liquid funds as well, which is clearly there to be deployed in the equity markets as and when the markets correct. But yes, this 3,500 crores of SIP book we're talking of is actually a main anchor on which the flows are coming.
Right. As far as, in terms of mutual fund is concerned, can you just give us some data that, every time it's been talked about that, mutual fund flows would turn around, mutual fund flows would, enough has happened in terms of inflows. But still in terms of percentage of investment into equity, it's still very low. So if it has to match up with some of the other emerging markets, still a lot of fund flows can be expected.
Yeah, I don't have the exact data with me, but you're right. I think if you look at the percentage of equity invested by mutual funds vis-a-vis, say, India or other markets, it would be pretty low. And I think the trend of equity investing through mutual fund is picking up in a very big way. So we still have a very long way to go. And what is also happening is, like earlier 10 years back or 15 years back, you had very attractive schemes by the government which promised a relatively higher rate of return on a risk-free basis. So they are virtually not present. I mean, even if they are present, they have issues of either a long liquidity, or the rates are very low, or they have other issues such as, you really need to make an effort to go and do a post office savings or other savings. So mutual fund actually offers all those conveniences of investing, plus a track record of having delivered a better rate of return on a risk-adjusted basis against any traditional form of investment. So if you look at these factors and the fact that investors have tasted success in the last 3 years and 5 years, so there is a case for the share of mutual funds to go up. But I see this trend continuing. So I don't have the exact percentages with me right now. But whatever it is, I mean, I would expect easily the industry size to probably double in the next 5 to 6 years to maintain the same tempo that they have maintained, what we have been maintaining in the last 4 to 5 years.
And do you think these flows will continue to the traditional favorites of the domestic fund houses, where do you think the money will go to? Those spaces that have already performed so far, or are they now looking for value and looking at some stocks where the earnings growth may not be very certain, but they offer better value?
See, I can talk about our funds in specific. So we typically whatever flows that we are getting at this point of time, we typically tend to invest in sectors where we believe there is a good value to invest at the current levels, and not necessarily in the existing holdings where we have. So if you look at the sectors which we would tend to focus on now specifically, would probably be healthcare and information technology. And to some extent, probably automobile also, we would be looking to increase our stake because post demonetization the sector has underperformed, and still the longer term attractiveness of the sector still remains good. So the valuations have corrected a little bit, but still the longer term attractiveness of the sector is pretty good. So these are the three sectors that I would focus on in the current moment.
All right. What about the other spaces which have run up quite a bit? Would you then look to lighten up here? We've seen some of the consumer names move up well. Some of the financials have moved up well. Would you be cautious here? Do you think there is still room for more upside?
Yeah, amongst the sectors that, I believe consumer has kind of moved back from where it was. So it corrected a little bit after demonetization, but again it has recovered strongly in the last couple of months. And even if you look at the sector valuations, they remain pretty high at this moment, without any kind of a sharp earning growth which is probably required to justify this kind of a valuation. So I would still be circumspect of consumer and would look to lighten up consumer names if it's there. And the second part is also probably maybe some amount of retail oriented private sector banks which have also run up very sharply. I would probably book some profits on that. But having said that, they are still a structural story. So maybe the valuations are 5%, 10% above the longer term mean. It doesn't make any sense. That doesn't call for a complete exit, but yes, it probably calls for trimming 5 to 10% of the portfolio that you would have. These are the two names. And the third one is metals. We don't have much of metals, but again, metal stocks have run up quite a lot. And today, we are kind of exposed to the global cycle, which has probably not supported the run up. So there remains the risk reward trade being a little unfavorable in metals at the moment, and that is another sector that I would look to sell at this current moment.
All right. What about the defensive bets that have largely underperformed so far, IT and pharma? Do you think there the valuation comfort exists for you to invest, or do you think because of the global uncertainties you would still avoid them?
See, I think if you look at both these sectors, they have different dynamics. So coming specifically to IT has done, or rather IT has underperformed more on account of fears of what would happen in the US immigration rather than any kind of demand destruction fears. So yes, those fears are not exactly unfounded, but we believe that all these actions would translate into a higher cost of doing business, which is factored into the valuations. But what is not factored is that now most of the companies are looking to do a capital reorganization or do a kind of a share buyback or improve their dividend payout to ensure that this free cash flow yields that they have at the current moment gets back to the investor in one way or the other, which is probably not factored into the valuation. So there remains the 10 to 15% kind of a return solely based on this. The second part is that some pockets of the industry is looking to go up. Like for example, if you look at the US banking sector, that has done very well in the last 6 months. And if you are talking of a Fed rate hike, there is a case of those banking sector profits to go up, which would actually benefit the Indian IT sector because banking still remains 40 to 50% of the Indian IT sector. So there are some pockets of growth in the IT sector. And there is a increased cost of doing business because of this immigration laws, whatever changes happens. I guess both are balanced, and plus you have this this capital restructuring possibility for the entire sector, not only the top 3-4 companies, given the fact that the sector has huge free cash flows and a very low balance sheet and low capex kind of a requirement. If you look at these three factors, I think there is a good case for investing in the IT sector. The second one is pharma. Again, pharma has underperformed because of different reasons, because of the regulatory woes surrounding the top 5-6 companies, And secondly, because also the fact that most of the companies had good presence in the emerging markets, which haven't done too well on the currency front in the last 2-3 years. Now, coming to the first part, I think some companies have kind of come out of the US, regulatory woes, and are getting the benefit of that in terms of higher approvals, and some companies are yet to come out. But given the fact that it takes 2 to 3 years for the companies to come out, I guess in the next 2 to 3 quarters, we would see the remaining companies also coming out, and there remains a very good growth pipeline for the sector for the next couple of years as far as the US is concerned. If you look at the other markets, whether it's the emerging markets or the Indian markets, those have still done well, and we expect the growth to pick up in a big way probably in the second half of 18 and also in 19. So from a 2 to 3 year perspective, it makes a very good case to invest in the sector.
All right. Thank you so much, Mr. Srivatsa, for speaking with us and giving us your bets where you think there can be money to be made and what could be the near-term trend for the markets with so many events lined up.